welcome to the briefing for June year-end reporters. The full accounting reminders are available on Viewpoint, but over the next few minutes I will explain the key issues for each topic. If you want to jump to a particular section, the timestamps are on screen now. The March 2021 IFRIC update included an agenda decision on configuration and customisation costs in a cloud computing arrangement. The agenda decision includes steps which entities should consider in accounting for such costs. This agenda decision might require an entity to re-evaluate the accounting for such costs incurred in previous reporting periods, in particular if they were capitalised. Agenda decisions often provide explanatory material which can result in voluntary accounting policy changes in accordance with IAS 8, as they arise from new information. Voluntary changes in accounting policies are applied retrospectively unless impracticable. Practically, while it might be expected that a 31st of December 2021 reporter would have sufficient time to analyse this IFRIC decision, it may not be able to do so for the 30th of June 2021 financial report. Disclosures in a June 2021 financial report explaining their process and timing of any expected change should be made if this is a significant policy. In autumn 2020, the FRC released their annual review of corporate reporting as well as 4 thematics. In September, thematics on IFRS 15 and IFRS 16 were released. In November, a thematic on cash flow and liquidity was released, which includes a useful summary of cash flow statement errors requiring restatement following review by the FRC's corporate reporting team, which I would encourage all preparers of cash flow statements to take a look at. In November, the FRC also issued a substantial thematic on climate change. This consisted of a suite of reports looking at all aspects of climate change reporting and auditing, including the role of boards, companies, auditors, professional associations and investors in considering and responding to climate-related issues, which concluded that all parties need to do more. In addition to this, in November, the FCA announced that for periods beginning from the 1st of January 2021, premium issuers in the UK will be required to report on the Task Force of Climate-Related Financial Disclosures, TCFD, on a comply or explain basis. BEIS have also issued a consultation to require mandatory reporting on climate change for publicly quoted companies, including a number of AIM companies, large private companies and limited liability partnerships from periods beginning on or after the 6th of April 2022. On to Brexit. For some entities, the implementation period completion date on the 31st of December and the EU-UK Trade Cooperation Agreement agreed on the 24th of December 2020 might introduce additional risks that should be factored into reporting. An additional consideration is that there was a change in tax status when the implementation period ended on the 31st of December 2020. Various tax exemptions and reliefs arising from EU membership no longer apply to UK companies, and in some cases to other EU companies transacting with the UK. Therefore, it is important to identify these exposures and consider the tax accounting consequences. Changes have also been made to UK company law as it applies to corporate reporting in order to address issues arising from the UK's exit from the EU, with some important changes to exceptions and exemptions that will be relevant for some companies. For companies reporting in compliance with the UK Companies Act, reporters will need to change how they refer to the IFRS-based framework they have applied in certain sets of financial statements. For periods beginning on or after the 1st of January 2021, UK companies using IFRS will apply UK-adopted IFRS. However, there are transitional rules that will impact financial statements for periods beginning on or before the 31st of December 2020, but which are signed after the 31st of December 2020, the end of the Brexit transition period. These changes therefore impact June 2021 year ends. The IASB have issued an IFRS 16 amendment which provides an optional practical expedient if certain conditions are met for lessees from assessing whether a rent concession related to COVID-19 is a lease modification. Lessees can elect to account for such rent concessions in the same way as they would if they were not lease modifications. In many cases, this will result in accounting for the concession as a variable lease payment in the period or periods in which the event or condition that triggers the reduced payment occurs. For UK entities, there has also been an amendment to FRS 102, which differs from the amendment to IFRS 16, setting out clear requirements for recognising changes in operating lease payments arising from COVID-19 related rent concessions on a systematic basis over the periods the change in lease payments is intended to compensate. From a front half perspective, there are a couple of things to note. Firstly, while the streamlined energy and carbon reporting, or SECR, is no longer new, we have noted that some disclosures are either missing or incomplete. Particularly, we have noted that some companies have missed disclosures of energy consumptions in kilowatt hours and energy efficiency action taken in the year. Secondly, for those entities applying the UK Corporate Governance Code, it is worth looking at the guidance that the FRC issued in February 2021, with advice to companies on how to report transparently, noting several instances where departures from the code had not been recognised. The government made a number of budget announcements in March 2021. These include confirming that the rate of corporation tax will increase to 25% from the 1st of April 2023, extending loss carryback for businesses, a super deduction for plant and machinery, various tax reliefs for free ports, consultation on R&D tax relief schemes, and a review of the bank surcharge. The important date for tax reporting purposes is the date of substantive enactment. For financial reporting purposes under IFRS and UK GAAP, taxation balances are only adjusted for a change in tax law if the change has been substantively enacted by the balance sheet date. The corporation tax rate increase was substantively enacted on the 24th of May 2021, meaning that companies with a 30th of June 2021 year end will need to update the measurement of their deferred tax balances. Deferred tax assets and liabilities are required to be measured at the tax rates that are expected to apply to the period in which the asset is realised or the liability is settled. Therefore, companies will need to determine when deferred tax balances are expected to reverse and what tax rate will apply in the reversal period. The increase in rate will not affect deferred tax that is expected to reverse before the 1st of April 2023, but it will affect later reversals. On to IBOR reform. Since the financial crisis, the replacement of interbank benchmark offered rates, known as IBORs, has become a priority for global regulators. This is an ongoing process and is happening at different speeds in different parts of the world, but is expected to happen by about 2021 or 2022 in most parts of the world. The IASB has released 2 phases of amendments to give reliefs from the effects of IBOR reform. Given the pervasive nature of IBOR-based contracts, the reliefs could impact companies in all industries. The Phase 1 amendments, issued in September 2019, cover amendments to IFRS 9, IAS 39 and IFRS 7 that provide temporary relief from applying specific hedge accounting requirements to hedging relationships directly affected by IBOR reform. These amendments are mandatory and should be applied for annual periods beginning on or after the 1st of January 2020, with earlier application permitted. The Phase 2 amendments, issued in August last year, cover amendments to IFRS 9, IAS 39, IFRS 7, IFRS 4 and IFRS 16 that address issues that arise during the reform of an interest rate benchmark, including the replacement of one benchmark with an alternative. These amendments are effective for annual periods beginning on or after the 1st of January 2021, with early application permitted. Accounting correctly for supplier financing arrangements has attracted significant attention from regulators since the failure of Carillion, with focus, amongst other areas, on a company's source of finances. This includes whether a company has made material use of supplier finance arrangements, if this is transparent from the annual report, whether the related balances are appropriately presented as bank debt or trade creditors, and whether subsequent cash flows are appropriately presented. In the UK, the regulator has indicated it expects better disclosures around supplier financing arrangements than companies are currently providing. The accounting for supplier finance arrangements will depend on the exact facts and circumstances relating to them. We continue to see a large number of questions on the restructuring of issued debt instruments, for example loan facilities or bond financing, and modification of derivatives to take advantage of low interest rates. This is a complex area of accounting which can require significant judgment. To assist companies in understanding the potential issues, some of the key accounting considerations under IAS 39 and IFRS 9 are summarised in our accounting reminders. These include determining whether the new and old debt have substantially different terms, the treatment of a gain or loss on modification or extinguishment of the debt, the treatment of fees incurred as part of the renegotiation, the use of an intermediary, and the modification of derivatives. In January, the IASB issued educational material to remind entities preparing financial statements in this difficult environment on what needs to be considered when providing the going concern disclosure required by IAS 1. The document focuses on judgmental areas where there are significant doubts over going concern, but where mitigating actions are sufficient for going concern to be appropriate. Where material uncertainties remain, it highlights the need to disclose the uncertainties, as well as information about the judgments made to conclude that going concern is appropriate. Reference is also made to the agenda decision in 2014, which concludes that when mitigating factors are in place, and it has been concluded that there are no material uncertainties, such conclusions would involve significant judgment requiring disclosure under IAS 1.